Hey there, road warriors. Welcome back to Highway Hacks, the podcast where we talk real trucker talk about real trucker problems. I'm your host, Penny, and wow, do I have an episode for you today. You know, when I first started driving, my dispatcher handed me a settlement sheet, and I just stared at it. CPM, deadhead miles, detention time, per diem, escrow deductions. It looked like someone threw a dictionary at a calculator and said, make it mean something. And here's the thing, that settlement sheet is literally your paycheck. It's your money. Yet so many drivers I know tell me they don't really understand how they're getting paid. Some guys have asked me, Penny, should I challenge my miles? Others say, my gross pay says $2,400, but I only got $1,600 deposited. Where did the rest go? Sound familiar? Yeah, that's why today we're doing a deep dive into trucking compensation in America. And I'm not doing it alone. We have in the studio with us today Alice. Yes, that's her real name, and yes, she gets that joke about every 5 minutes. Alice is a payroll and settlement specialist who's been helping trucking companies and drivers navigate the wild world of trucking compensation for over 12 years. Alice, welcome to the show.
Thank you so much for having me, Penny. I'm excited to be here. And yeah, I've accepted the nickname. There are worse things.
So, Alice, before we dive into the nitty-gritty, I have to ask, why is trucking pay so complicated? I mean, other jobs just have an hourly rate. Why can't we?
Great question. And honestly, it's because trucking is legitimately a complicated business. You've got time elements, how long you wait at a shipper. You've got distance elements, how far you drive. You've got load elements, whether you're carrying freight or running empty. And then you've got all these special situations, breakdowns, detention at a customer, layovers between shifts. Traditional hourly pay doesn't account for any of that complexity. So the industry created this structure that tries to pay for what you're actually doing. Okay, that makes sense. But it also explains why drivers need to understand their paychecks, right? Absolutely. Because if you don't understand it, you can't verify it's correct. You can't plan financially, and honestly, you might be leaving money on the table. All right, listeners, buckle up. We've got a lot to cover today. Let's start with the foundation, CPM. So, CPM, what does it stand for, and why should every driver care? CPM stands for cents per mile. It's the most common way trucking companies in the United States compensate their drivers for the primary part of the job, getting your truck from point A to point B with cargo. Instead of paying you $25 an hour, they're saying for every mile you drive, you get paid a certain number of cents. And what's a typical CPM rate? I know it varies, but give me a ballpark. In 2024, CPM rates range anywhere from about 35 cents per mile for newer drivers, all the way up to 65, sometimes 70 cents per mile for experienced long-haul drivers. It really depends on your experience, your safety record, the type of freight, and the carrier. Okay, so let's say I'm making 50 cents per mile. I do a 600-mile run, that's $300, right? That's the basic math, yes. 600 miles times $0.50 equals $300. But, and this is a big but, not every mile on your settlement sheet is the same. Here's where it gets tricky. Exactly. There are two ways carriers measure the miles you drive: actual miles driven and practical miles. What's the difference? Actual miles are exactly that, the odometer miles. You can verify them yourself, but many carriers use what's called practical miles, which are calculated based on the route itself, not necessarily the exact road you took. So if I take a longer route to avoid traffic, but the carrier's system calculates a more direct route, I might not get paid for those extra miles? Bingo. This is where a lot of drivers get frustrated. You physically drove 660 miles, but the carrier's dispatch system calculated the practical route as 600 miles. You get paid for 600. That seems harsh. I hear you, and a lot of drivers feel the same. But from the carrier's perspective, they controlled the dispatch. If they could avoid giving you empty miles, they would, because they have to pay for them too. Empty miles are unprofitable, so they'll try to minimize them. But when they happen, how they're compensated is a contract issue between you and the carrier. Okay, so empty miles are trailer off. What about deadhead?
Deadhead miles are when you're driving your tractor without any trailer at all, just your tractor. Your own tractor, no cargo, no trailer yet. Most carriers don't pay for deadhead miles. It's considered part of your job. So, deadhead miles pay better or worse than empty? Typically worse, or sometimes not at all. The logic is you have no trailer, no cargo, so the carrier gets nothing out of it. Most deadhead miles are paid at a very low rate, or unpaid. Some carriers might give you like 10 cents per mile for deadhead, others give nothing. That seems harsh. I agree, but again, that's negotiation at the time of hire. Some newer carriers are getting smarter about this. They realize that deadhead pay affects driver retention and satisfaction, but it's still not standardized. All right, last one, Bobtail. Bobtail is when you're driving your tractor to a shipper to pick up your first load of the day, or a trailer. Your own tractor, no cargo, no trailer yet. Most carriers don't pay for Bobtail miles. It's considered part of your job. So let me recap. Loaded miles pay the most, your full CPM. Empty miles pay less, deadhead pays even less or nothing. Bobtail is typically unpaid. Is that right? That's a good summary, though I want to stress every carrier is different. You have to read your contract. Some carriers have more generous policies. But yes, that's the typical hierarchy. All right, so we've got primary pay, CPM on different types of miles. That's the base, but there's more money, right? Yes, this is where accessorial pay comes in, and this is where a lot of drivers don't realize they're losing money. Accessorial sounds like something you buy at an accessory store.
I get that, but accessorial pay is literally additional compensation for additional work. It's not your CPM, it's on top of your CPM. Okay, so what kinds of work trigger accessorial pay? The main ones are detention, layover pay, stop-off pay, and breakdown pay. Let me explain each. Start with detention. Detention is when you arrive at a shipper or receiver and you have to wait before you can load or unload your cargo. The shipper is busy or their dock is full or something unexpected happens. You're sitting there waiting, burning fuel to keep your engine running maybe, unable to take another load. And the company's going to pay me for that wait time? They should, yes. Detention pay is typically after a certain threshold. For example, a carrier might say, first 2 hours of waiting at a shipper are free. After 2 hours, you get paid detention. Rates vary. Could be $10 per hour, could be $20 per hour, could be a flat fee. But I have to claim it? This is critical. Yes, many times you have to claim it. You need to document the time you arrived and the time you left, and then you submit it to your dispatcher or your carrier's claims department. If you don't claim it, you don't get paid. That seems like something the carrier should track automatically. Ideally, yes, and some carriers do, especially the larger ones with electronic logbooks, but not all, and even if they track arrival and departure times, you might need to explain why you were detained. Was the dock busy? Was there a paperwork issue? You need documentation. Okay, so detention is waiting time at a facility. What about layover? Layover is different. Layover is when you're forced to wait between loads or when your dispatcher tells you to wait for a specific load that's not ready yet. You might be at a truck stop, you might be at a shipper, but you're essentially on call, waiting. And that pays too? Some carriers offer layover pay, some don't. If they do, it's usually a flat amount, like $50 per night or $100 per layover period. It's less than detention because you're not necessarily waiting at a facility doing nothing. You could be sleeping, resting, handling your logbook, but you're not earning CPM because you're not driving. So if I'm waiting for my next load and there's no layover pay policy, I just don't get paid? Correct, you're on unpaid waiting time. Again, this is something to negotiate at hire. Some companies are generous with layover pay, others aren't. Some drivers prefer companies that have high CPM rates and no layover pay, and they manage it by asking for better paying freight loads. Others prefer steady, predictable layover pay. What about stop-off pay? Stop-off pay is for when you make more than one pickup or drop-off in a single load assignment. For example, you pick up freight at warehouse A, drive to warehouse B and drop half, then drive to warehouse C and drop the rest. That's multiple stops, hence stop-off pay. Why does that warrant extra pay? Because it's extra work. You're dealing with extra paperwork, extra dock time, possibly unloading partial loads, managing which freight goes where. It's more complicated than a simple A to B run. Stop-off pay is usually a flat fee per stop. Could be $25 per stop, $50 per stop. Depends on the carrier. Is that automatic? Again, usually not. You might need to flag it, although if your carrier uses electronic dispatch systems, the stops are logged and you might get paid automatically. But I've seen cases where a driver didn't realize they qualified for stop-off pay and never claimed it. This is frustrating. It sounds like the driver has to be their own accountant. Welcome to trucking, yes. And this is actually the reason I recommend drivers keep their own records, your own logbook, your own notes about stops, detention times, because sometimes the carrier's records and your records might not match. What's the last one? Breakdown pay? Breakdown pay is when your truck breaks down and you can't drive. If the breakdown is the carrier's fault, meaning they didn't maintain the truck properly, or there was a mechanical failure that's a maintenance issue, some carriers will pay breakdown pay. It's usually a reduced hourly rate. Reduced hourly rate? I thought we don't do hourly. Right, normally you don't, but for breakdowns, some carriers switch to an hourly model. You might get $15 an hour for the time the truck is down. Not great, but it's something. What if the breakdown is my fault? If the carrier determines it's driver error, like you ran over something that damaged the truck, or you didn't do your pre-trip inspection properly, then you might not get breakdown pay. You might even be charged a deductible for the repair. This gets legal and complicated fast, which is why you need a clear contract. All right, so we've got mileage pay and we've got accessorial pay. These are gross income sources, right? Right, now we need to talk about what happens to that money after you earn it. So I do my 600 loaded miles at 50 cents per mile, that's $300. I get detention pay of $100, that's $400. Does $400 hit my bank account? No, that $400 is your gross pay. Your gross pay is the total amount you've earned before deductions. And what gets deducted? Several things. First, federal income tax, Social Security tax, or FICA, and Medicare. If you're a company driver, your employer withholds these automatically, just like any job. If you're an owner-operator or lease driver, you might have to pay these quarterly. These are pretty standard. Okay, those are taxes. What else? Depending on your carrier, you might have 1. CSA insurance deduction. CSA stands for CAA Safety Alliance. Some carriers require drivers to contribute to a safety insurance pool. This might be $50 to $200 per week, depending on the carrier's policy. 2. Escrow or prepaid expenses. Some carriers hold back money from your pay to cover things like truck damage deductibles, or road taxes, or toll payments. This goes into an escrow account. 3. Health insurance, dental, vision. If your carrier offers these benefits and you're enrolled, your share comes out of your paycheck. 4. Fuel surcharge deductions. Some carriers will collect a fuel surcharge from you. You get paid at a high CPM rate, but they take back a fuel surcharge as a deduction. 5. Logbook violations or safety incidents. If you have a safety violation, some carriers will deduct from your pay. This is controversial and varies by contract. 6. Uniform or equipment deductions. If you lose or damage carrier property like a trailer key, a logbook, company uniform, they might deduct it from your pay. So between taxes and these other deductions, what kind of percentage are we talking? Could be anywhere from 20 to 40% of your gross pay, depending on the situation. Federal income tax alone is usually 12 to 22% for a trucker driver's income bracket. Add Social Security and Medicare, another 15.3% combined, though split between employee and employer. Then, if you have CSA insurance, health insurance, escrow deductions, you could easily be looking at 30 to 40% reduction from gross to net. So if I earn $2,000 gross, I might get $1,200 to $1,600 net? That's a realistic example, yes. That's why my dispatcher makes the announcement to the crew like, you guys are gonna be rich, and then I get paid and it's not what I expected. Yeah, that's the difference between gross and net. And one more thing, per diem.
What's per diem? Per diem is a daily allowance for meals and incidental expenses when you're away from home. The IRS allows a certain amount per day. Currently, it's around $69 per day for truck drivers, though this changes. Some carriers give you a per diem payment directly. Others just deduct your per diem expenses from your gross pay before calculating taxes.
So it's like a tax deduction?
Kind of. It's intended to offset meal and incidental expenses you have while on the road. If you get $69 per diem per day and you're out for 10 days, that's $690 that reduces your taxable income. But I don't get a check for $690. It depends on how your carrier handles it. Some carriers actually give you the per diem as a payment separate from your wage. Others just deduct it from your gross pay calculation. Either way, the goal is to reduce your taxable income and offset your actual meal expenses. All right, so gross pay minus taxes, insurance, escrow, and other deductions equals net pay. That's what hits my bank account.
Got it.
Exactly. But how do I verify all of this is correct? This is the part that scared me when I first started. The settlement sheet is like a foreign language. Walk me through what I should look for. Okay, I'm going to give you the essential checklist. When you get your settlement sheet, you need to verify 1. Your name and ID number. Make sure it's you. Sounds silly, but mistakes happen. 2. Pay period. What dates does this payment cover? If you think you worked a week and it only covers 5 days, something's off. 3. Loaded miles. This is the big one. Count your bills of lading. How many loads did you do? What was the total mileage on those loads? Does it match the settlement sheet? How do I verify this if the dispatch system shows practical miles? Good question. You can ask your dispatcher for a breakdown. Which loads, which practical mile numbers? Compare against your logbook notes. If there's a consistent discrepancy, like every week you're 50 miles short, bring it up. 4. Empty miles, Deadhead, Bobtail. The sheet should itemize these separately. Check the quantity and the rate. 5. Accessorial pay. Here's where you need your records. Do you have detention claims documented? Stop-offs? Did you submit them? Are they on the sheet? If you claimed detention and it's not there, that's a problem. So I'm supposed to track all of this myself? Ideally, yes. Keep a simple spreadsheet or notebook. Date, load number, origin and destination, miles, any detention or extra stops. It'll help you verify your settlement sheet and also help if there's ever a dispute. 6. Deductions. Each deduction should be itemized. CSA insurance, taxes, insurance premiums, escrow contributions. Don't just see a big number and ignore it. Understand what's being deducted and why. 7. Per diem. Check if it's applied. If you were out 10 days, you should see 10 days of per diem. 8. Gross versus net. Do the math. Gross minus deductions should equal net. If the math doesn't add up, ask. And if something doesn't match, what do I do? You talk to your dispatcher or your payroll department or whoever handles settlement at your carrier. You say, I have a question about my settlement sheet. I show 620 miles loaded, but the sheet shows 600. Can you help me understand the discrepancy? Stay professional, stay factual, have your documentation. What if they can't explain it? Then escalate. Ask for the payroll manager. Ask for a written explanation. Most carriers want to get this right. They don't want unhappy drivers, but you have to advocate for yourself. That's what I'm hearing throughout this whole episode. You have to be involved. Absolutely. You're a business. Your truck is your business. You need to know your financials, just like any other business owner would. All right, Alice, I want to ask you a few questions that I know listeners are wondering about. Shoot. Scenario 1. I've been driving for Company X for 6 months. I just found out that last month I could have claimed detention pay on 3 different loads, but I didn't know about it. Can I go back and claim that money? It depends on the carrier's policy. Some carriers allow you to retroactively claim accessorial pay for a certain window, like 30 days or 90 days. Others say it's too late. This should be in your employee handbook or contract. If it's not, ask HR. The worst they can say is no, but if there's a policy allowing back claims, take advantage of it. Scenario 2. I'm an owner-operator and I just calculated that I'm earning $1.20 per mile total, CPM plus my efficiency bonuses and all accessorial pay combined. But I have to pay fuel, maintenance, insurance, my truck payment. My actual take-home is like 60 cents a mile after all expenses. Is that normal? It is for an owner-operator, yes, but it's tight. Typical owner-operators gross 80 cents to $1.50 per mile and net about 30 cents to 50 cents per mile after all expenses. If you're netting 60 cents, that's actually pretty good, depending on your expenses, but you should run the numbers carefully. Make sure you're accounting for truck payment, fuel, maintenance, tires, insurance, permits, taxes, and a reserve for downtime. If you're not, you might be underestimating your real costs. Scenario 3. My dispatcher says, "We don't pay for Bobtail miles. I drive to the shipper every morning with no trailer. That's 20 miles every day, 5 days a week. Is that fair?" Honestly, it's borderline. Bobtail to your first load of the day is often considered part of starting work, but 20 miles every day, 5 days a week is 100 miles a week you're not getting paid for. Over a year, that's 5,000 miles. At 50 cents a mile, that's $2,500 a year you're not earning. I'd negotiate it. Ask your dispatcher, can I start at the shipper instead of the yard? Can you adjust my daily start time? Or ask for a small daily stipend to cover Bobtail. There's usually some flexibility. Last scenario. I got paid and my deductions seem higher this month than last month, but I didn't enroll in any new benefits. Why would that happen? A few reasons. 1, if your gross pay was higher, your federal income tax withholding might be higher. It's percentage-based. 2, your carrier might have changed insurance plans or deduction policies. They should notify you, but check. 3, there could be a one-time deduction for something, damage restitution, for example. Read the line items carefully. If you can't figure it out, ask your payroll department. Don't just accept a higher deduction without understanding why. That's really good advice. Alice, before we wrap up, what's the one thing you want every truck driver listening to this episode to take away? Know your contract, know your pay structure, verify your settlement sheet every week, and keep records, logbook, notes, photographs of detention signs, whatever it takes. You're running a business, even if you're employed. Treat your pay and your finances like a business, because if you don't, nobody else will. That's solid. Thank you so much for being here, Alice. Thank you for having me, Penny. This was fun. Well, folks, there you have it. Episode 17 of Highway Hacks, Show Me the Money. We covered a lot of ground today. CPM and practical miles, the 5 types of miles, loaded, empty, deadhead, bobtail, and short route, how to claim accessorial pay, detention, layover, stop-off, and breakdown, the difference between gross and net pay, how to read your settlement sheet, real-world scenarios and solutions. If there's one thing I want you to remember, your paycheck is your responsibility to verify and understand. You work hard out there on the road. Make sure you're being paid fairly. Have questions about your settlement sheet? Join our Highway Hacks community online, link in the show notes. Post your questions and we'll help you decode that paycheck. Thanks again to Alice for being here, and thank you listeners for tuning in. If you found this episode helpful, please leave a review, subscribe, and share it with a fellow driver. I'm Penny, and I'll see you down the road. Stay safe out there.